Good afternoon and welcome. I'm Bill McLaughlin, Editor-in-Chief of Furniture Today and Editorial Director for Bridgetower Media's Home Furnishings Division. I'd like to welcome you to our first Retail Planning Guide virtual event. The Furniture Today Retail Planning Guide is an annual issue looking to forecast growth in key categories of the furniture industry and looking at key drivers of the business that will shape the industry in the coming year. This year, we've tried to bring you a little bit of extra analysis and insight with this event, and we'll have 3 sessions today. The first will be a discussion between myself and 2 senior level editors at Furniture Today, Sheila Long O'Mara, our executive editor for Furniture and Bedding, and Joanne Friedrich, who oversees the research department for Bridgetower Media's Home Furnishings Division. We'll follow that with a discussion of commercial real estate with some key industry experts, and we'll close the day with a discussion with industry icon Jerry Epperson. We'll discuss the year ahead and as well look at the outlook for mergers and acquisitions. Before we get started, I'd like to thank our sponsors, GigaCloud and 25 Home. Without the support of sponsors like these, we could not put on these types of events. We hope that you'll enjoy this event and be able to use the information you gain and insights that are provided to drive your business to success in 2024 and beyond. Let's get started with our program.
Hi, I'm John Anderson, Director of Business Development at GigaCloud, pioneer of global end-to-end B2B e-commerce solutions for large parcel merchandise. I'm so excited for today's session on the economic and industry outlook for 2024. We'll cover the truth about the recession, predict the furniture industry's turnaround, and discover the impact on various categories. Furniture Today editors Bill, Sheila, and research editor Joanne will reveal the key factors shaping the next year.
Good afternoon and welcome to Furniture Today's Retail Planning Guide event. Each year, Furniture Today comes out with a retail planning guide in the last issue of December. It's our forecast for the coming year. This year, for the first time, we've decided to add a digital component and bring you some additional insights. Today's program will feature an outlook for the commercial real estate segment, looking at what retailers might face in the coming year. And we've also brought in industry icon Jerry Epperson to talk about the M&A outlook for 2024. Before we get started with that, we have our own team here. I have with me today Sheila Long O'Mara, Executive Editor of Furniture and Bedding at Furniture Today, and Joanne Friedrich, Research Editor for Bridgetower Media's Home Furnishings Division. So we just like to kind of set the stage and talk a little bit about some of the factors that shaped 2023 and some of the things you can expect for 2024. Joanne, you were looking at the industry all throughout the year. With this year, when we did the top 100, I think we reported that almost half of the top 100 reported losses this year. That was correct, isn't it?
It is correct. It was, I think, in the 40s, 42, 45, somewhere in there. So yeah, it was almost half.
And when you look at that, I believe for the first time in a number of years, we're projecting that the industry will actually go backwards this year. What is it that you saw in terms of how the industry will finish 2023?
Yes, we are predicting that it's going to be down by 3.2%. And this year, the top 100 was down by almost 1%. Our 3.2% might be considered conservative by some people because, there have been reports of double-digit declines by some companies, but we kind of look at the highs, the lows, and try to land somewhere in the middle. So I think our 3.2 might be a little conservative, but let's hope that's as low as the industry goes for this year. And then looking at next year, we have it down again by 0.4%.
Well, let's look at 2024. Sheila, you talked to folks on both the bedding and the furniture side. I don't think anyone saw this year ending up in positive territory, right? We've all heard the joke, flat or slightly down is the new up. What are you hearing from people in terms of how they see 2024 playing out?
No one's very optimistic. Like you said, flat are 2% down as the new normal. So, and we just left the leadership conference in Florida where we were joined by a significant number of people. And so those conversations were interesting as we talked about, okay, what does 2024 look like for you? Nobody's crying the blues, but they're all very realistic in their expectations, right? So there are a lot of factors that are playing into it that cause people some concern about where we're headed. And originally, people acknowledged that maybe the second half of 2024, we would see things inch back up. We were going to start digging out of our trough. But those expectations have now shifted, and most folks are acknowledging that it's probably going to be 2025 before anything starts to trend in a positive direction. We've got an election year coming up. So that always throws things a little upside down, and crazy inflation rates. Inflation is still a problem, and interest rates are still up. And that's slowed housing, of course. So nobody's touting very much positive information here.
Yeah, a lot of the fundamentals that people look at to drive the furniture business, whether it's housing starts, new starts, sales of existing homes. Joanne, you had pulled some statistics on interest rates. We've seen an enormous number of interest rate hikes over the last year or so. What did you find?
Yeah, from March of 22 through July of 23, the Fed has raised rates 11 times. And going into next year, that's not going to be the case probably, but inflation is at about 4%. The Fed would like to get it to 2%. So there is still opportunity for them to, play with the rates again. We're seeing mortgage rates come down a little bit. They were over 8%. Now they're about 7.2. So that's positive movement. Unemployment, has been below 4. It just fell again to 3.7, but predictions for next year are that unemployment will go up. So like Sheila said, looking at next year, the first 2 quarters for sure are going to be bad, and maybe through the end of next year. And especially for the furniture segment. This year, other parts of the economy have done better. Consumers actually spent money, even though we've had high inflation and high interest rates, but they didn't spend money on furniture. They spent money on things for themselves, travel and entertainment, apparel, things like that. So unfortunately, furniture didn't see that bump this year that other categories did.
Yeah, I think Beyonce and Taylor Swift had a very good year for concerts, but obviously people weren't spending that on new sofas. Sheila, were you going to say something there?
I was going to piggyback on what Joanne said about interest rates. That's the other thing that people that we've been having conversations with, they expect another interest rate bump. And they're planning that into their forecast. How could that affect everything, right? But the other thing is, traveling through airports, we've been in a lot of those this month. They're packed. It's not just business travelers; it's people traveling with families, and they stayed cooped up during the pandemic for so long, and now they're spending all their money. But I do think when you look back at where we were the last couple of years with the pandemic, there was a significant amount of pull-through sales. You don't buy a mattress every year. You don't buy a sofa every year. And when we look at the end of 2020 and the beginning of 2021, when everyone was investing in their homes, their homes are pretty set right now. So there's a cooling off period that I think we're weathering right now, whether we want to or not.
Yeah, it's funny. We talk about interest rates, and I have the benefit of having recorded the next couple of segments, right? So just so you all know, we're not live. This is pre-recorded. But in both of the next two conversations, you can hear interest rates came up again and again. It affects people's ability to go open new stores. It's absolutely impacting the M&A sector in terms of making things more expensive. We've seen a number of companies close in the last year, and that's because of part of that is a constricting of credit. So I think until the credit situation kind of stabilizes and interest rates start to come down, I think that's constraining a lot of parts of the business, whether that's on the retail side, the manufacturer side, in terms of M&A or in terms of consumer spending. The other thing I think that's interesting is we talk about the impact that experiences are having, pulling dollars right out of consumers' discretionary budgets. But I think this dovetails interestingly with something else we've been watching for the last couple of years, which is the emergence of millennial and Gen Z consumers in the marketplace. And they tend to be, at least from all the research that we've done and look at, they tend to be experiential consumers. They are as interested they're less acquisitive in terms of, I'm a baby boomer. The joke for our generation is whoever dies with the most toys wins, right? That was kind of almost like a teacup saying throughout the 80s and 90s. But I don't think that the next generation measures success the same way. They want to accumulate, but what they want to accumulate is experiences. So when you have this dovetailing, I think, of younger consumers coming in who are more experientially focused, at the same time, you have constraints on their ability to spend. We did see also the end of the stimulus money over the last 12 to 18 months. And we've also seen student loan payments start to revive. And that's, that's hundreds of millions of dollars of discretionary dollars. And I think it's important to people who are watching, remember, furniture is a discretionary purchase. It's a high ticket purchase. It's often very credit sensitive, or it often requires credit. So all of these things are factoring in. But interestingly, Joanne, as we looked, because you and I were talking the other day, as we look at 2024, we see the back half, people are starting to say the back half will pick up, but the impact of that is going to actually lag. So as the factors that come in, the factors that could lead to an improvement start to improve, there's still going to be a gap, isn't there?
Right.
In terms of
definitely. That it's going to take a while for there to be improvement, and the furniture industry isn't going to benefit from that. It's not going to ride the same wave. It's going to be at the end of the wave, not along with the wave. And it's interesting when you're talking about credit, because I just read something that credit card debt is now 1.2 trillion and has gone up 6% over the last year. So that's the other thing. People have been buying, but they're buying on credit. And eventually they're going to have to pay those bills. So that's another factor that could slow down the economy going into next year.
Let's talk about some of the business that we've seen. I mean, I don't want to project the sense that this is all gloom and doom, because people are still selling lots and lots of furniture, right? This is still a business that's well north of $100 billion annually. We still know companies, we said, 42 of the top 100 were down. Well, that means the majority were up, right? There are still folks who are doing quite well. Let's talk about some of the things that are actually doing well in the business. I mean, if I look at some of the categories, motion upholstery seems to have become a very, very hot category. Outdoor seems to continue. That really emerged during the pandemic when people wanted to get outside just to feel like but it hasn't really lost some momentum. Sheila, what are you seeing in terms of some of the segments of the business that are performing well?
So outdoor, of course, like you just mentioned, motion, because everybody for a while, they're cocooning and then they found those comfortable things. In the bedding segment, adjustable bed bases are still growing, a relatively new category, right? So they've still got some growth to do. And people, it's still a cozy time. If you're not out traveling, you want to be comfortable in your home, in your bed. there was a wave during the pandemic with boxed beds, but I think that's pulled back a little bit as people can go into stores and try. But like I said, we sold a lot of mattresses and a lot of sofas and a lot of outdoor furniture during COVID. They're not things that you buy every year. It's very interesting on a psychographic sort of way to examine how consumers think, how they operate, but you lock people down for 2 years and off they go. So
the interesting thing demographically about both motion and adjustable bases, you would think historically, you tend to think of those as older purchases, people who are a little bit later in their life cycle. But the research shows that millennials and Gen Z consumers actually use their bedroom in a different way, right? They read in bed, they play games in bed, they're eating in bed. So that adjustable base actually aligns. Yeah, I know. Crumbs in the bed, right?
sorry.
But there's, when you look at why would adjustable bases be grown, there is a demographic component to that as it aligns with an emerging lifestyle trend, which is millennials and Gen Z consumers use their homes in a different way.
And they gather in their homes, as the parent of one. I mean, they gather at each other's homes instead of always going out, so they're watching movies, they're gaming, and what better place to game than kicked back in a reclining sofa or whatever. And so they create in-home experiences where they can, because, spending money is a big deal for them.
Well, I think the other thing too, from the motion upholstery standpoint, is we've seen what I'll call the democratization of non-motion looks, right? Historically, when you looked at a motion, a recliner or a motion sofa, it looked like a piece of motion furniture. And we've seen a real dramatic proliferation of furniture. You can't tell whether it's stationary or motion. So I think some of the barriers, the traditional barriers to that becoming a more widespread, more popular purchase have been broken down. And now you can get the exact same look, everything you want in terms of, lifestyle, but you get that added benefit. So when you eliminate a pain point and then you deliver a benefit, I think that's one of the interesting things that we're seeing there. Joanne, you also do work for our Home Accents Today publication, and you've done some things there with their universe study. Is the accent side suffering the same way furniture is?
No, actually, we have the accent business up this year by around 2%. And, part of that is that people may not be making a big purchase. They made like Sheila said, they made those big purchases, a couple of years ago during the pandemic, but they still want to freshen things up. So they're buying rugs, they're buying decorative accessories, they're buying accent pillows, they're even buying, some small accent furniture items. Those were all categories that we had up, 1.5% to 2.5%. So we are still seeing some action in that category. And, that's something that is also sold through traditional furniture stores, not just home accent stores. So there is some pickup of business for furniture retailers in those categories.
Yeah.
Cash and carry, right? Cash and carry. You just scoop it up, you pay for it, you put it in your car, you take it home, you've got a whole new look.
I think that also speaks to the point you made earlier, Sheila, about you don't buy a sofa, you don't buy a bed every month, every year, but you could buy pillows seasonally. You could buy wall art seasonally. You can change your look for a relatively small amount. And it's a good opportunity for retailers to increase the foot traffic through the store, get people in there more often, engage them more. It's a great follow-up purchase. You bought a sofa. How about some pillows? So, I do hope that as our audience listens to this forecast and thinks about how do you structure your business for 2024, be diversified, right? It's a business that's made up of many segments. All millennials don't behave the same. All Gen Z don't behave the same. And they all don't make up percent of the business. So I think that's one of the things that, Joanne, you see a lot when you do research, that segmentation, right? It's building those pieces. Were there any other insights that you can share with us from some of the research that you've been doing throughout the course of the year, whether it's just for Furniture Today or some of the other books? What other insights have you seen that might help people put themselves on better footing for 2024?
When you've sold the sofa, you've sold the mattress, you've sold whatever you've sold that's big, how do you stay in contact with that consumer, right? Because eventually she's going to want a new floor lamp to go next to the sofa. She's going to want pillows. She's going to want a new piece of art. So I think it's important for retail partners to stay in contact with consumers who have already purchased so that you can communicate. Oh my goodness, we just got this whole great slate of lights in. They would be great with your sofa that you bought, last year. Come check it out. Or we just got a whole collection of new pillows in if you're looking to refresh for the holidays. Just a way to stay in touch with consumers after they purchase big items so you can keep pulling them back in for new things that happen to make your registers ring, right?
One of the other things that one of the pieces of good news that I've been hearing of late, we've all talked about that backlog of inventory that retailers have had. Most of the retailers that I've spoken with in the last couple of months seem to say that they've worked through their inventory issues. They're now ready to start refreshing. They're looking for new products on their floor. But the interesting thing is, and then Joanne, I know you've done some research on this on imports and exports, is that we're seeing the sourcing equation shift a little bit. There seems to be companies taking a fresh look at places that they may not have looked before, whether you want to call it onshoring, nearshoring. Joanne, in terms of import-export figures, what have you seen in the most recent report in terms of the growth or decline of imports of furniture and furnishings into the U.S.?
Well, we've definitely seen a drop-off from both China and Vietnam, which are the two big players, and growth in, some other countries that you hadn't typically thought about, like Cambodia or Malaysia or, some of those. So,
yeah, I think there seem to be a number of factors at play there. I mean, we've had, obviously, there's tariff issues. Those continue to be a factor in the business. I think the supply chain, what we call the supply chain crisis of 2021, when container rates went through the roof and shipping times. The other thing is, I know we saw a big shift in 2019 and 2020 to Vietnam, but the infrastructure there is still catching up with the proliferation of factories. Sheila, you just came back from Mexico. We're seeing a lot of activity, it seems, in Mexico. Do you think we're going to continue to see that on the bedding and furniture side?
Specific to bedding, we're in the middle of the third round of anti-dumping petitions that some U.S. manufacturers have brought, and there are 13 countries that are on that list. And Mexico is one of those. So some Mexican manufacturers are looking for, and some have already procured, factories in the States where they're going to, they'll bore their foam, they'll make their springs in Mexico, bring those across the border, and then build the mattresses in the U.S. Just because we don't know what the Trade Commission, what their ruling is going to be on tariffs. So there are pushes specifically for mattresses, especially when it has to do with Mexico because they're on that list, to bring manufacturing into the U.S. where possible. And there are a couple of manufacturers that are working toward that goal to secure plants here. So for case goods, though, I think that Mexico is probably and upholstery, a very lucrative spot just because logistics, it's easier, it's faster, and there's a big labor pool there.
It seems that we're going to continue to see a realignment. It seems very much in flux. We've also seen a lot of companies trying to look at India as a new source. We've talked to a number of companies that are starting to try to figure out that equation. The issue seems to be scale, right? And commercialization, factories that can produce at scale rather than artisan manufacture. So let's just take a quick poll. Raise your hand if you expect global sourcing to continue to be in flux in 2024. There you go. It's unanimous.
Yeah.
That is still an area that is very much in flux. So as we look at, obviously, we're trying to project 2024. Most, you can agree or disagree. The insight or the consensus seems to be first quarter, we're going to continue, largely a continuation of 2023, not significant change. Second quarter, really pretty much the same, dependent on interest rates, because this seems to be a very contingent projection. And I know that when we were figuring out what our projections were, there's a lot of caveats, right? If interest rates go up again, how long do they continue to go up? Sheila, you mentioned the election. That's going to certainly make it, if nothing else, it's going to make it expensive for companies to advertise. Once we get past June, the rates for advertising are going to go through the roof as all of those political dollars flood in and airspace becomes constrained.
Along those lines, at the leadership conference, I was in a group of retailers and we were talking about digital, specifically about digital marketing and digital advertising and how you can increase that audience. And the conversation of the election came up and somebody said, oh my gosh, it gets so expensive, just as you were saying, to advertise because of the political ads that eat up all the airspace. Digital doesn't have the same rules. So maybe there's an opportunity, to turn up your digital marketing dollars during, the second half, to continue to have that conversation with the consumer and stay in front of them that, furniture still matters for their homes.
That's the other thing that we've seen in conversations with retailers is the media mix is changing, right? The percentage allocation to print has decreased substantially. Television still seems to be, for a lot of traditional retailers, a medium of choice, but increasingly we are seeing people try to take advantage of digital formats, whether that's Google AdWords or Instagram, TikTok, any of those other social formats. So it'll be interesting to track that as we go through the year.
Streaming TV as well.
I'm sorry, Joanne?
Streaming TV as well. That's the whole category that, wasn't really around for until the past few years. And people have been looking to that because it's a cheaper format.
Yeah.
All of these things make it a much more complex equation, though. For us baby boomers, we remember there were 3, maybe 5 channels, right? So it was, those 3 main networks you had to choose. Now, Joanne, you mentioned streaming networks. That's a very fragmented segment. As a streamer myself, you've got to belong to 3, 4, 5 services. And how do you figure out where to put those dollars and allocate? It's made it a much more complex media equation for companies.
And it's hard to measure. It's hard to measure your return on investment on streaming platforms.
Mm-hmm. Well, it sounds like we are projecting a very complex, very contingent environment for 2024. Are there any other things you'd like to share with our audience before we go? Any parting thoughts as they start to plan 2020?
Well, I think one of the things we should look to is that they are projecting that housing will turn around, and that's a good thing. Housing starts, home purchases, all of that is expected to improve. And, that bodes well for the industry, although, like we said earlier, not at the same time this happens, but it's something to look forward to.
That is good news. I think strategic planning is going to be important, especially when we think about what it's going to look like. And let's be honest, nobody really knows. We've got 2 wars in the world and we're not involved specifically, but that causes some chaos too. So I think it's going to be a roller coaster ride. So I would suggest plan, be nimble when you need to be nimble, and hold on tight.
For myself, I would say be diverse. And by that, I mean, when you look at housing improving, it's not going to improve. It's not going to improve from the lowest priced house all the way up to the highest priced house, right? Consumers are not equally impacted by interest rates. So I think those companies that position themselves to be able to target their product offering or their store mix to the broadest number of consumers, think about what aligns with the consumer you're trying to attract. And don't put all your eggs in one basket. I think in the same way that an investment advisor might say to you, you don't want to put all your money in one or two stocks. I think that's the same here for the furniture industry. You don't want to put all of your attention on one segment or two segments. So I think the ability, as you say, Sheila, to be nimble, the ability to have a diverse offering by style, but also by price point. Because one of the things we've seen is the market has been dramatically impacted differently from the low end to the mid to the high. So if you don't have the ability to be able to shift your mix as the opportunities arrive, I think that could be something that determines winners and losers in 2024 and beyond. So I'd like to thank you both for taking the time today. Really appreciate it. I hope the rest of you enjoy the rest of our program. Please reach out to us and let us know what other kinds of offerings you'd like to see. We enjoy bringing in experts to help improve your business. Our goal always is to help you drive better business. So on behalf of the team at Furniture Today, thank you for tuning in, and please enjoy the rest of the program.
GigaCloud is a pioneer of global end-to-end B2B commerce solutions for large parcel merchandise. We provide seamless, integrated e-commerce solutions for the entire supply chain. We're a leader in the global B2B landscape, and we just announced our third consecutive quarter of record-breaking profitability. To learn more about GigaCloud in our marketplace, visit gigacloudtech.com and gigab2b.com.
Hello again from 25 Home, your prospective import partner for furniture. It's an honor and a pleasure to introduce the second content session of the Furniture Today Retail Planning Guide. In this session, we will discuss the commercial real estate outlook for the U.S. market in 2024 and how it relates to your business. 25 Home would love to connect with your company in the following weeks to share how can we support your goals for sales and growth this coming year.
Well, welcome. Our next session today is to talk about the outlook in 2024 and beyond for commercial real estate. We have with us here today two experts specifically in the furniture space, gentlemen with long-term experience in the furniture industry. We have with us Julius Feinblum, founder and president of Julius Feinblum LLC, and Ben Haverty, leader of Colliers Real Estate Group. Gentlemen, thank you for taking the time with us today. I appreciate it.
Happy to be here.
Thank you, Bill.
So I'd like to get right into it. The furniture industry and retail in particular has been so disrupted that I'd like to get your take, and Julius, we'll start with you. How would you describe the current environment for retail real estate? Do we find ourselves with lots of available inventory? Are we in a tight market? Is it a buyer's market, a seller's market? I know that's kind of open-ended, but if I could get each of you to kind of give us a kind of state of the market, how would you characterize the current market for retail real estate?
The current market is pretty historically the same in that A-grade properties, which means retail properties that command a large amount of sales per foot, that can bring in a large amount of sales per foot, are still very expensive and very hard to properly find. The B grades are a lot more value-oriented and represent a good presence in the marketplace, and their rents have either down 3 to 5% or at levels pre-COVID. The C's are the real interesting areas, assuming you have the shoe that fits the shoe, the feet that fit the shoe, meaning there's only a limited amount of furniture retailers in today's world that can live with a C location. Historically, C's was what most independent retailers took. But in today's world, the last 10 years, it's proven that location really creates sales per foot. So the C's are the opportunities. And what do I mean by a C? An example, a closed Macy's in a dead mall, or a closed Sears in a dead mall, meaning it's got a great presence and it probably has great economics. And if it's acquired or leased, it's probably going to be a very good value.
Ben, did the pandemic have an effect on what is an A, what is a B, what is a C? Are we seeing any fallout from the pandemic in the real estate space, and how, what makes a good location?
Well, I'm going to say I agree with Julius that overall, retail demand is up. Supply is down. New construction is very limited, and therefore prices are going up. It's just pure supply and demand. Most large retailers, successful retailers, want to grow their footprint. They're looking for space. I'd say a great example is what happened when all the Bed Bath & Beyond locations came on the market. There was a food fight for those locations. I mean, there was LOIs, 4, 5, 6 deep of major retailers trying to get those. And so furniture retailers are competing for those same spaces. So the perception was the pandemic killed retail. Retail was going to be oversupplied. There was very little demand. And that was a very brief moment. But as soon as the pandemic was over, as you saw, retail demand popped back up. Retail stores started reopening dramatically. Retailers wanted to grow. And so right now, A, real estate is commanding A, prices, period. And B, real estate is, again, a little more challenged, as Julius said, C's at the bottom of the barrel, and there's a little more value, and you have to be creative about using it. But overall, it's a landlord's market right now. It's a good time to be a retail landlord because you're raising rents, period.
Bill, could I add something to the Bed Bath situation, since I acted as consultant at the bankruptcy court for several retailers, furniture retailers. It's ironic that at the bankruptcy, there were a majority of players were furniture retailers nationwide. Mm-hmm. And after now, trying to cherry pick some of the buildings at better values, B's and C's, there's many deals that we've been doing with all over America. So the notion that the furniture industry is having a rough time, the facts are is true, but the desire, like Ben said, for successful retailers, furniture retailers, they have an appetite, and when they see value, they do react.
Let me ask you a question about size, because, you talk about some of these locations, right? A former Sears location, or that tends to be a little larger than the average furniture store, whereas Bed Bath & Beyond might better align what are you seeing in terms of, and Ben, I'll start with you this time. What are you seeing in terms of store sizes that furniture stores find most attractive in the market right now? Are they getting larger? Are they getting smaller? Do you have to take what you can get and then try to size it? How are retailers having to deal with that particular issue?
On a national level, probably early 2000s, the average furniture store is running around 40,000 square feet. That has now shrunk to now 2023. The stats show the average furniture store is down to about 30 to 35,000 square feet. And so that could be a process of some people saying, hey, I don't need as big a store to get the same square foot. The availability is another challenge because you're up against other major national chains for bigger boxes as well. And again, not many new big boxes are being built, and so it's a little more difficult to find. But as we know, there's definitely some retailers who like a very large footprint, a City Furniture, Nebraska Furniture Mart, where they're building super stores that are gargantuan and are obviously very impressive and are outside the norm in size. But on average, we're seeing nationally, the national stats are about 30 to 35,000 square feet is the average furniture store out there.
Julie, why is that average coming down? Is that the internet effect? People are showrooming. I mean, let me not put words in your mouth. Why do you think that's coming down?
First, let me answer that we're seeing a very sharp increase in requests for finding 100 to 150,000 foot stores. Now, they're not full stores. What they are is a store with a warehouse. In other words, and it's visible from off the highway, and it's in many, many major areas, and we're seeing a very large request for that from some of the major players. The other issue that you were bringing out was there is two things happening. There's the R Houses world and the Ethan Allens of the world that are doing 12, 15, 18,000 foot stores. They're the Ashleys that are doing anywhere from 20 to 30,000. The most furniture retailers are very flexible as to size if the deal is right. So we're seeing it all over the place. So I really can't say that there's a drop off in the amount of footage because this is something I've seen many, many, many years. The Ethan Allens or people like our house, it used to be Thomasville, or that was their size. And then of course Jake Jabs was the originator of the huge superstores and living spaces in the Western Mart in California. And now, based on their success, it's spread throughout America.
You raised an interesting issue there, the relationship between the showroom space and the warehouse space. Are you seeing any shift in the allocation of that space? Are retailers taking spaces with larger warehouse, or is it a function of perhaps a retailer who's looking to expand is trying to use that store warehouse as a DC? Are we seeing any change in the way retailers allocate that space between showroom and warehouse?
Yes, exactly what you just said. You answered the question. What they're doing, using it as a regional distribution to support one or two other killer stores. Normally you'd have 5 stores in a market. They have this one big anchor with the warehouse, and then they'll have 2 to 3 or 4, where they may have had even 7 in the market. So they are downsizing the amount of stores in the market, but the square footage amount is almost the same.
Ben, we've talked to a lot of retailers who are starting to try to improve their e-commerce business. Furniture retailers recognize that they have to play in that space. Does that weigh into the store warehouse equation? In other words, do they need to have to recalculate how they buy or allocate space so that they can support e-commerce operations, or is that just done at, well, let me not finish the question. I may answer my own question.
Well, my experience right now is most traditional furniture retailers, their e-commerce business, they're aggressively trying to grow it, but it's not a significant amount of their business to have to totally readjust their distribution strategy. It is a complement to the business. It is not controlling the business. And so most of them are trying to run it through their existing warehouse distribution, almost like customer pickup in some ways. They're doing it. And then a lot of retailers are using 3PLs to handle, especially deliveries that are outside of the normal delivery range. So if it's outside 200 miles of their DC, they may be using a third party to step in and deliver that to Florida. Raymore Flanigan, they use a third party to deliver customers who have places in Florida. And so it is not yet such a big part of the business that it's dramatically changing their warehouse strategy. Julius, I'm curious what you see.
I see the same thing. I only see, as far as the internet, I remember when about 7 years ago, we all were a little panicking in the retail real estate industry that the internet would hurt the bricks and mortar business. And ironically, exactly what Ben is saying, it's just an adjunct. It's just an adjunct, and it's helped a lot to get their story across. But everybody likes to most people want to feel and touch and sit, sleep in it, to get a feel of the furniture. It's like buying a house. They have all these services now where you could almost do it online with video. But who's going to do that? You're going to look at it. That'll maybe make your appetite to do it, but it's not the final decision. And yes, there's all forms now of delivering furniture. There's all forms of storing furniture. And we've seen that they're doing these regionals only because that's a market where they don't have a central warehouse. So they're starting off from scratch, the new market. And so this is a way to tell the retail story very strong, the internet story very strong, and the delivery to make sure their back end is good at delivery.
Ben, if we look at the history of locations, I'm old enough to remember when malls killed the downtown, right? And then freestanding specialty stores, strip malls kind of killed the big mall. What do you see as the trajectory of where we're headed in terms of what makes a location attractive? Is it, so if I'm a retailer, I mean, obviously I want sight lines, I want, some things, but in terms of, do I want to go find another anchor? Do I want to be by another? What today, and as we look into tomorrow, what's the trend line? What's the trajectory of what it is that makes a location attractive?
Well, and Julius has already said it, but location, and what makes a good location in most cases is obviously density of population. Is enough people nearby to shop? Is it visibility from the road where there's high traffic? That's obviously something most retailers are still looking for. They, as Julius said, they'd love to be right next to the expressway with their big exit. Is it have accessibility? Do you have drive-by, or can you actually get off and get to it? And then does it have convenient parking? Is a big issue because most people are still traveling to a store. And so being near population centers, having good visibility, having good access, good traffic count continues to be, core needs that every retailer wants. And then affordability is a big issue. Can I afford to be here? And does the land of the building accommodate my merchandising strategy? If I've got a 100,000 foot merchandising strategy and the building's only 20,000, it probably won't work for me, even though it might be a great location.
Julie, there was a time where people talked about Walmart killing lots of smaller businesses. And what we've seen in a lot of cases is with Walmart as in a shopping center, there's an opportunity for lots of complementary stores to feed off that traffic. And I don't want to specifically pick on Walmart, but from the standpoint of a furniture store, are there types of stores, whether it's a Walmart, a supermarket? What do I want to locate near in terms of other retail outlets? What makes good partnerships or good complementary businesses to be around me?
Great question. When I started doing this 30 years ago, I looked at areas where they had the auto industry, the auto showrooms on the highways, and saw that auto guys clustered right next to each other, and it was an auto row. And if you're going to buy a car, you'd go to the different brands, and it was like created for that. And then I noticed in an area called Farmingdale, Long Island, that there were 17 furniture stores in a 1 mile area. And then I noticed in San Diego, the same thing. So I started realizing that the industry gravitated towards living off the other players. And they weren't as much concerned about, at that time, it may not have been a Walmart, but whoever key retailer it was at that time. That picture changed, not a great deal, but it has changed. And so there are success stories of companies that do inline next to a Ross stores or a TJ Maxx. But what the problem is you're paying common area maintenance and rents that are predicated on very large foot traffic. And when you get a slowdown in an economy, those stores, their profit margins for the chain or for the individual decreases very rapidly, whereas a freestanding store has a certain amount of protection on different items of costs. And of course, if you buy a freestanding property, that's even better. So the answer is, it's still 70% is the old-fashioned way, and 30% you could live in a superpower center. And when you get rough times, it's not as good. In good times, it's good.
I love that shout out to Farmingdale. I'm a Long Island native. I shopped for my first furniture on Route 110 in Farmingdale. It was right. It was the furniture row, up and down. You could just go and pick.
And I said, wait a minute. I wonder if this is true in California. I wonder if it's true in other parts of America, in Las Vegas, Nevada, different places. And I personally created about 3 million square feet of that throughout America with a couple of major developers, Kimco, the largest on the New York Stock Exchange. So there was a formula, and that formula still exists, but there are variations, and I would say that only 70% of retailers will do that, and 30% want to be next to the high-powered national non-furniture retailers.
Ben, you look like you had something you wanted to
I was just going to say, I agree with Julius 100%. I think clustering is still a very strong desire of retailers. The visibility is a big one. For many, many years, probably for 3 or 4 decades, one of the hottest places for a furniture store to be was on the ring road of the regional furniture mall. There's the regional mall, because regional mall was bringing people in from 30, 40, 50 miles, and the furniture store didn't want to be in the mall. They just wanted to be on the road around the mall. And that was a very successful formula for 30 years until probably the pandemic, and when we started to see department stores deteriorate. And so that's no longer a strategy, but it was for many, many years. And it's gone back to clustering is still the most favored space for furniture retailers to go.
Would you advise a furniture retailer who's looking to open a new location to go seek out a complementary furniture store? So let's say, theoretically, I'm in that promotional to mid area. Is there a value if I know that there's a mid-price retailer who may also be? Do you see any of those combinations where people consciously look to cooperate? Ben?
I'm going to say yes. Again, so much. I'm not sure they some plan ahead of time and say, "Hey, I'm looking at this market. You're looking at this market." And if they're sophisticated enough and they have a large enough internal real estate, or they have a very savvy broker, they may put them together and say, "Hey, Haverty's, Rooms to Go wants to both. Y'all both want to go in Huntsville, Alabama. Why don't y'all buy land together, develop it, and have two different stores?" And occasionally that happens, but that's hard to execute. Julius can testify that getting retailers to agree on much is difficult, but it is in their best interest when they can or when the opportunity is there.
I agree totally. I've done several, and my biggest one will be opening, I believe, in about 3 months, or with the construction that will start. But already it has a Super Ashley and a Super Rooms to Go, and it's going to have a Super City furniture. But what's interesting is you're 100% right. You would think it would make sense, but I found that everybody has egos, and everybody wants to be at the right corner and not the middle or the left side, and it all becomes more complicated. This is tough enough, as Ben knows, just to do one store right. And then when you try to put the three guys that are competitors or close to being competitors, it's not as simple as it seems, with the eye.
Yeah, everybody wants to sit at the head of the table, right?
It goes.
So one of the things that came up at our recent leadership conference, it was in the context of a merger and acquisition discussion, where there are some retailers, as they look to exit the business, they want to sell the business, but they want to retain that real estate, right? I mean, that real estate has value. That's an annuity for them over time. And Julie, I'll give you first crack at this. What's your sense of that asset relative to the rest of the business, and how easy or how much easier or how much harder it makes it for a retailer who wants to retire and retain that real estate while still selling the business?
I think that many retailers decide that they want to sell, and then what happens, or retire, and they are not going through the proper process. And the process is that it should be, real estate deal should be made before you do a sale. The exploring of a sale of a business the first factor should be the real estate, not a GOB, and then, well, let's try to sell it, or sell it simultaneously. And it's something that most people don't understand. And it makes it very complicated to sell a small business because of that. When you get into the larger deals, it's easier to accomplish.
Ben, what advice would you give to somebody who's deciding they want to make that choice? Do they have to consider selling that real estate? I mean, or do you just take less money? What did you advise from the standpoint of helping walking somebody through that process?
Okay. There are two schools of thought. There are two advices. One is how good is the real estate? If the real estate has a very good value, then you should want to sell it to another furniture guy. That's where you're going to get your highest price because of a lot of reasons. The value of the business has the traffic, and the sales have a value. The reputation, the build out may or may not be able to survive, but it's still less expensive. And so that is why that's how we started. We negotiated a deal for a major retailer that went out of business but owned all its own real estate. And so we wound up placing all of the stores with furniture guys. You know, it was logical. Plus, remember, most older locations in furniture only have limited parking. They, in today's world of retail, 4-to-1 is the minimum that a prominent non-furniture retailer would approve.
I agree with Julius in that most independent retailers are in two businesses. They're in the furniture business, and they use the money earned there to pay rent on their appreciating real estate. And so they're in the furniture business and they're in the real estate investment business. And they're, again, using furniture to buy real estate, either showrooms or warehouses, and paying the rent with the hope of they've got a long-term appreciating asset that has grown in dramatic value over the 20, 30 years of the business's life. And then they can retire either by selling that asset or leasing that asset. And that's a great strategy, and lots of independent retailers have made as much money on their real estate as they have on their business. But like everything else, you need to make sure that real estate is, if the neighborhood around is deteriorating, the price will deteriorate. If the building is not maintained, the price is going to deteriorate. If the use for it, again, there's not many people who need 100,000-foot showroom. That's usually having come and spend the money to subdivide that. Or if you have a warehouse that's got a very low ceiling or a choppy floor, it has lost a lot of value. And I see a lot of retailers saying, hey, I want to sell my building, and their expectation is they're going to get 3x, but the market says, hey, the market around the neighborhood around your store has changed and it's worth 1x now. And so retailers need to have realistic expectations about that real estate investment that they've made. Is it still holding is it appreciating or going down? And in a market like that where interest rates are so prominent and there's going to be fewer people bidding for the property, they're going to get less money in the current environment for their property because the value's down because of interest rates. So timing is still a big issue on when you sell or lease your real estate.
Ben, let me ask you a question about lease versus own. It seems like the model for most furniture stores is to do exactly what you said, to own your real estate, to use that for. Are there situations where it makes more sense for a furniture store to lease their store rather than own, or is it always the best strategy to try to own your building?
Well, I think obviously every situation is unique and different, and if you need to be in a specific market, it's just such a hot market and the only opportunity to lease, then that's going to be your only choice. Again, we meet lots of retailers who say, hey, I'm in the real estate business first, I'm in the retail business second. And so I'm not looking for the best real estate, I'm looking the best affordable real estate for me, that I can buy it, I can run my business, and I know it's going to appreciate, but it may not be the A+ retail location. Most public companies like a Havertys or an Ethan Allen, Wall Street doesn't want them to own their real estate. They want them to lease it because they say, hey, if you're in the furniture business, you need to be making your money selling furniture, not being in the real estate business. And so that's where you see most public furniture companies don't own their real estate. They're leasing it because they've got that pressure from Wall Street to use their assets towards growing the furniture business, not growing their real estate holdings.
The same, did I just say so? The same with venture capital and hedge fund of these furniture companies. It's the same thing. They don't want the money being used for the hard asset. And so they have connections with real estate investors that will provide the capital for the real estate, but that the function of the retailer is to grow the store count and create a great picture of the retail furniture retail.
Okay, so we're coming toward the end of our time, but I do want to look ahead the interest rate environment now, as you look at the interest rates, as you look at what your prediction is for the economy, whether it's a recession, whether it's soft landing, whether it's going to improve, is this, as you look at 2024, and Julie, I'll give you first, and then Ben will come to you. Is this a good time for retailers to be thinking about getting new stores, expanding new stores, or is this a time where you think it's better to sit back and hold on?
Again, it depends on the specific situation of the retailer. Example, if he's got 3 stores at the market and he has a son-in-law that just joined the company, and the son-in-law says, why aren't we in this new area where it's growing? He's going to react whether the interest rate is high or low. It's a matter of needs. Of course, interest rates plays a large factor in pro-forming what you're going to pay for the rent or buy the property at. But at the end of the day, it's more on motivation of the entrepreneur. Now, there's another aspect to this. Most furniture retailers of medium size or lower, if you ask them about, do you want to expand, where would you like to go or whatever, they'll say, oh, I'm not doing anything now for the next 6 months or so, a year. Well, it's been my experience over so many years that when I come up with the right deal, all of a sudden they buy. So they're very smart and entrepreneurial, and they know how to survive. And what I see in 2024 is similar opportunities in a different way than the Bed Bath Beyond, but where you have retailers that have a big, non-furniture retailers that have a large footprint and want to downsize the footprint because regular soft good business is not that great. So there are going to be some very interesting opportunities. But of course, you have to have the connections to be able to put those deals together and the right clients to put the deals together.
So Ben, I understand that, opportunities present themselves and you have to be flexible. Situations are individual. But as a retailer who's looking at trying to make some judgments about what they're going to do in the next 12 to 18 months, what kind of advice could you offer to how they should think about the real estate equation in that, say, short to medium term time frame?
As Julia said, opportunity is always the number one driver. It's the right property at the right price coming available in a desired market. If that happens, it's time to move. Even if interest rates are high or construction side, because that opportunity may not come back again for a decade or so. And so opportunity is a big one. And then obviously you need to make sure that you're prepared, make sure that your balance sheet's strong, that your ability to borrow money is strong, your team is strong. And so strong retailers will grow in a good environment and a bad environment. Weak retailers will always have an excuse not to grow. Things are too expensive, rent's too high, too much competition. And so it does come down to being circumstances, opportunity, and also being prepared as a retailer to grow. Right now, like I said, rents are up, and so that's always a concern. Property demand is up, and opportunity is also going to be up, as Julia said. As big retailers decide to perhaps scale down some of their buildings, there'll be some opportunities for retailers who want to grow.
Okay, gentlemen, I feel like we barely scratched the surface of this topic. So let me say this to our viewers here today. If you'd like to hear more, these gentlemen are always very accommodating, very willing to take some time. So if you'd like us to talk a little bit more with them, please reach out to me at bmclaughlin@furnituretoday.com, and I will kindly prevail upon their good nature to get them back on here. We'll talk some more. Till next time, happy shopping, happy buying, and let's go on with more of our program.
Thank you very much.
Thank you, Bill.
Hi, I'm John from GigaCloud. Join me for a dynamic 2024 M&A Outlook session with industry icon Jerry Epperson and Furniture Today. Explore the present and future landscape of M&A. Is now the right time to sell? What factors should potential buyers consider? Tune in for the insights essential to position your company for success in 2024 and beyond.
Good afternoon. Welcome to our next session. My guest, and I'm very lucky to have him with us today, is Jerry Epperson, partner in the firm Mann, Armistead, and Epperson, someone you all know. And whether or not you know this, Jerry is the longest tenured writer at Furniture Today.
I should ask Paige, shouldn't I?
There you go. Jerry, thanks for joining us today. I really appreciate it.
I'm flattered at the opportunity.
Jerry, why do you think there seems to be so much M&A activity in the last year? We seems like we're writing about it almost every other week.
It does seem that way, doesn't it? First of all, we had some weak links in our business. And the people that tend to know about the weak links first are the banks and the different other lending institutions who are keeping these weak links alive. And with the economy that we've had over this period of time, combined with raising rates has really dictated to the banks and lending institutions what they really shouldn't be doing. And so they're looking at everybody's portfolio. And you might have been okay when lending was 5%. But when lending rates are 8%, the risk level is dramatically higher. And so they review their portfolio again. And we're not willing to honor that much of a risk because the rates right now are more likely to be going to 10% than they are going back to 3 to 4%. I wonder, looking at mortgages, okay, mortgages right now are about 8%. We all know mortgages are going higher. And I question who's out there right now knowing that's willing to lend us at these rates. But, housing will be fine because there are lots of other concerns and they're involved. The other thing is we're an industry that has gone, believe it or not, a fairly long time since the last recession, which was 2007, 8, and 9. And during that time, a lot of people lost discipline, if you will, and kind of maybe added a few too many people. They put too many benefits in. They paid people probably more than they should. And as a result, they're vulnerable. The private equity groups, who we see so much of these days, have exploded in growth. I can remember when there were 2,300 private equity groups. I think they're now probably 10 times that. And they're of all different sizes, all different numbers of people, where they want to be in the pecking order of a deal. This one won't do one that doesn't have an EBITDA of less than 50, and this one won't do one unless it's got more than 100, and that kind of thing. So as these companies have gotten involved, and as I mentioned, if a deal isn't done, a private equity firm doesn't eat. They have to position this money and put it out there for them to get a fee for finding a deal to put in the portfolio. And then they collect a lesser fee. It's still a lot of money, but a lesser fee for managing the company going forward from there. And most are on a 5 to 7 year program where they want to work with the company, hopefully improve the company, and in 5 to 7 years, sell it for more money, and that can be distributed to their shareholders. So that's the program. If you get a private equity group that's held on to somebody more than 7 years, then they probably would be willing to sell it even if it hadn't reached their goals or if it wasn't a bad economy. There are private family groups out there that tend to hold much longer. And there are strategic buyers that tend to find what they want, and if it fits what they are trying to do, they keep them forever. But that's a whole different market we're looking at. I think we've got a few more people that are struggling to the point that their options are running out in all parts of the business, in all parts of the business.
Do you think we're heading for a shakeout? A significant shakeout as opposed to 1 year or one thing, right? I mean, a shakeout means you see a significant number of companies fall. There's always one or two who are poorly run companies that are going to die in any given year. But do you see some larger, broader kind of a shakeout coming next year?
I don't think it's going to stop anytime soon as long as rates are up and going higher. The incentive to go out and lend to people at lower rates isn't there. And that's what's kept these people alive. Some of these companies have not learned what it takes to do business today, and they're still doing business the way they always have. Some of these businesses have not spent on the technology and all that needs to be replaced. And some of these companies have just got new competitors in the marketplace, and they haven't woken up and made a change. And that's true for the vendors, which are both domestic manufacturers and importers, and the retailers, and a lot of the in-betweeners too. It's not as high profile, but we've seen some fairly significant e-commerce retailers quietly walk away into the dark woods, and we don't, you just suddenly don't hear from them anymore. So there are a lot of them gone.
Now that's an interesting point. We all heard about the retail apocalypse, right? E-commerce was going to put stores out of business, and it almost seems to some extent I don't want to say gone the other way, but there does seem to have been some fallout on the e-commerce side. Why do you think it's ended up that way, and stores actually continued to seem to be quite viable?
The easy answer is that if you look at the e-commerce specialists, I'm not talking about a major retailer that also does e-commerce. That's a different picture. It's real difficult to find many e-commerce pure retailers, and that's all they do is they do furniture, not home furnishings or decor, furniture and mattresses, and that's all they sell over the internet. If you go to look at how many there are of those that make any money, it's a long search, and often a very unyielding search. And some of these that are very high profile companies, they just keep throwing money after it. And, I certainly do. I want Wayfair to be successful. Okay. But Wayfair has built itself a huge capital base. It's spent a lot of money on a lot of things out there. And there's so much more than just being an e-commerce retailer. And that just concerns me. But look everywhere else. There aren't many people who are doing e-commerce in furniture and mattresses, those particular categories, because that's where the delivery is important. And that's where, getting the product into the home is so important. It's just a real challenge.
So the expectation for next year is that interest rates are going to continue to rise, at least for a period.
Yes.
What impact is that likely to have on merger and acquisition activity in 20 and to 24? Theoretically, it would seem that would constrain activity. And yet most of the folks that I talked to, and we had your partner, Howard, at the leadership conference, seem to suggest that there's going to be some significant activity still into 2024.
Well, a lot of money's been raised. There's more dry capital out there that needs to be invested than there ever has been. Some of the biggest of the big have got lots of money and are looking for places to put it. because it doesn't do them any good to keep it in the bank somewhere. So there's that money that doesn't require a bank approval. It doesn't require you to go out and find a lender. You can do that deal in-house. So that's going to create some deals. Also, a number of the companies that are out there right now owned by private equity groups want to take advantage of the industry's, I hate to say softness because it's not soft, it's dead. Business is just terrible. They want to find things that fit and that they can bring in under their umbrella so that when they sell it, they're selling more than just this. And that's important to these guys. So I think you're going to see some of those that have and are reasonably successful expand. I think we're going to see some people who recognize value. And that's really important. I'm getting ready to write a column for a very popular newspaper. And
maybe that is.
Well, let's put it this way. My 3-year-old grandson likes it because it's got my picture in it. So that gets me a lot of kudos. But somebody's got to look at our population mix and look at the trends that are going there. Is something going to happen in the next 18 months? No. But I really do want to be in this industry until about 30, 34. Because the demographics, the underlying population growth, the people that are going to be buying homes, decorating homes, and having kids, sending them to school, grow all through that period. Now, there reaches a time when the millennials sort of peter out, and that's not so good because we don't have much behind the millennials at this time to document, but you can document the growth going out to them. I want people to realize that you can go back to the beginning of COVID when the American people got $1,200 per taxpayer or per individual. And look what they did with it. It gave them a chance for the first time in a long time to buy things they really wanted but haven't had the money. And what did they buy? They bought home furnishings. And we had a great 2 years. And then that money, number one, ran out. And number two, the consumers decided to buy smaller ticket items, services, experiences, so forth. But they've shown that there's a big need for furniture and mattresses, and they're going to do that again the next time they have the money. If you look at sort of how the cash flow is going to work, we baby boomers, I'm one of the oldest baby boomers. I didn't see you at the convention. But we baby boomers are the wealthiest generation ever. You know, the money in our generation isn't just in the names of the Rockefellers and the people that used to be in control of all the money. It's spread out a lot wider. It's going down to different generational people. And this is going to be the biggest shift of money that has ever occurred. As the baby boomers pass away, and the older boomer right now, I believe, is 77, the oldest. When they start dying, and they are dying off, let's face it, I see that in your paper. Thank you for running those great recognition to those individuals. That money is beyond anyone's comprehension. I've seen articles estimating as high as $24 trillion. And then I've seen numerous articles that say 12 to 14. So you can't really quantify that in how much it's going to mean to anybody, because it's one of those things where you're probably either going to get a nice check, completely unexpected, and not particularly wanted. You don't want to lose a relative or someone you're close to just to get the money. But that's the way life works. And when that money comes through, it's important. It's giving you a whole new life. You can do things you've always wanted to, and your home is such an important element in all this. And with the new technologies that are driving people towards spending more time in the home, being more capable of doing things from the home, we're going to benefit from that. And the smart money knows that. The other thing that's coming along that I'm very proud of is young women and minorities are getting the same educational opportunities that used to be limited to old white men like you and me. And that is going to be a bigger change in terms of wealth and capability of this next generation than anything else, bigger than the inheritances, because these people are going to be out there accomplishing on their own. And they're going to spend it earlier in life than they probably would in the inheritance. So all that's coming in. But what we're missing right now is just confidence. Our media tell us a bad story all the time. We've got some politicians who really need to retire. Get out of the way and let some new blood in there. I think there are a lot of policies that need to be completely reconstructed. I think both parties need to really look at what they're doing and who they're doing it with, because we're scaring way more people than we're encouraging. But in terms of the industry you and I have lived with, and that we need to be healthy, the core things that make me want to stay around are still there. And the smart money is going to see that and want to participate. A lot of what happened when we went through our biggest boom of acquisitions in the early 1970s was, it was either Fortune or Forbes wrote an article about how great the furniture industry was going to be able to do because of all the baby boomers emerging. And when they wrote that article, they cited a couple that were doing pretty well at the time. And all of a sudden you had all the conglomerates back then decided they needed a participation in home furnishings and that generational growth that was going to occur. That's going to return because you got to follow the money and see where it's going. And little things happen. You may not want to redecorate your home until your best friend and next door neighbor do. And all of a sudden, you kind of want that. It's sort of like when the first time you saw an 85-inch TV in someone else's home. You didn't want an 85-inch TV, but you did afterwards, didn't you? That's so that's going to happen with us.
You raised an interesting point there. When you referenced the 70s, you talked about all of the conglomerates, right? These big outside entities that were outside the furniture business and came in. You seem to suggest that that's going to happen again. Do you see over the next couple of years a return of these kind of big outside corporations coming in to try to get it? Because it didn't seem to go so well the last time. Do you see a return of that in the coming years?
I think there are a lot of big companies out there looking at this business and scratching their heads as to, one, the timing of getting into it, and two, where do they want to be in the stack of players out there? You know, Ron Warnick was pretty open early in the day saying he wanted to be the Walmart of the furniture industry. He wanted to have value for all households to be able to come in and buy. And then he wanted it to really, there's no reason why furniture at all price points shouldn't be shown beautiful. You know, you can match the paints and the wallpapers and everything else as easily at inexpensive prices as extremely expensive prices. And, you know, you go in an Ashley store today and goodness knows it looks great. I mean, a lot of their stores, if you didn't know, weren't Ethan Allen or in the old days of Thomasville store, they show that. And they've got the designer patterns matched and everything looks great. Little things like if you use, say, Benjamin Moore paints, and on the wall behind that sofa that looks so perfectly matched, if you put on that wall what that Benjamin Moore paint is that brings it all to light, or even with your rugs, those kind of things are little tips that the consumer really loves, and they look for that, and Ashley does that. Not that others don't. I'm just saying that they have done probably a better job of reaching out to that particular consumer that are out starting households.
So going back to the types of companies that we might see entering the furniture business again, do you have some sense of where that, I mean, if you think back, right, it was Masco back in the day. Well, they were in tangential businesses, right? If I sell you faucets, I can sell you furniture. If I sell you, so are we going to see a return to that where we see folks who may be in tangential businesses come back to to try to add furniture? Or is it more of a money play? Say, look, we have money. We know this is a hot sector. Yeah, we don't have anything that relates, but you know what? It still makes money. I mean, how do you see that playing out?
The smart corporations are always getting in and getting out. You don't buy something and hold it forever, which has been the curse of many of these companies. Retailers have the same thing. You know, they'll buy a store, and the demographics around that store will change, and they'll keep that store even though their product mix and the people they're trying to sell to don't match at all. But that's just humankind. I think you're going to see a number of corporations looking at their portfolio and saying, where do I want to be? And one of the problems with furniture is, where in the pecking order do you want to be? Do you want to be urban, suburban? Do you want to be credit reliant or not? And some sectors get recognition, and all of a sudden they do fantastically well. They may not do fantastically well for 50 years, but for 10 or 15. You know, you look at outdoor furniture. You know, it's been strong. The hottest category in our entire business has been power motion. And power motion looks good. It feels good. It's an experience to have it. And once you have it, you don't want to give it up. Power beds, sort of the same thing. People just all of a sudden realize, you know, this really is pretty comfortable. And then other categories have lagged, and bedroom furniture and dining room furniture. We haven't done much to improve them. We haven't done a whole lot to make them better, more functional. And I think you're going to see some major advances in that. But a lot of that's being done overseas. Over 90% of the wood furniture is made overseas now that we sell in our stores. Just a touch under 50% of our upholstery is made overseas and brought in. In mattresses, it's right at 30% are being brought in. So we still have a huge domestic opportunity. But if you take a product like mattresses, which are so important to us, one, because it's the most frequent purchase. You buy it more often than just about anything else. Secondly, they continue to make huge technological advances so that the product that we have today sleeps better, will sleep better for a longer period of time, will often give you more options, and is safer than it's ever been. It really is, like most furniture products, a huge value, and you just have to understand why. And that's why some of our companies have done so well selling better quality mattresses. The consumer will pay $2,000, $3,000, $4,000, $5,000 if you show them why they should. And so we've gotten away from the $199 to $399 mattress, which used to be a barrier everybody had to fight through. So I think right now, if we could get the consumer to agree that there is a future. We've never had a downturn without having an upturn. We, as an industry, have never seen the industry go down to the degree it's gone down this cycle. Never. Okay? And it's going to come back, and it's going to come back. And if nothing else, we've created some easy numbers to beat. But I think the big difference is going to be that the consumer all of a sudden sees that they want to invest in their home and they're going to make money off investing in there. And having enough homes is a key right now because we don't have enough.
One of the things that seems to be happening, and I'm not sure why this is that we've seen a lot of traditional case goods players wanting to get into upholstery getting into case goods. We hear the words whole home much more frequently. And if we look at some of the recent acquisitions, it seems to be that seems to be the driving factor. The people want to be in as many possible categories as they can. Is that a function of something that's happening on the supply side? Is that a function of a declining retail base, or retailers are getting bigger, so manufacturers have to get bigger and be more efficient? What do you see driving this activity around whole home?
If you go back, which I do almost every minute, if you go back to past decades, what you'll see is that the wood furniture business has not gone up a lot. Their percent gains year after year just haven't been very significant, and certainly nothing like you've seen in upholstery in motion, or mattresses for that matter. Why? It's not because people don't want them. It's because the imports have made their prices go down and have kept their prices down. And it's just a truth right now that, wood furniture, if you could look at it in unit terms, and we don't have that capability, but if you look at it in unit terms, it may have grown close to what upholstery's done, but upholstery has outgrown wood furniture by 2, 3, 4 times. I can remember the first year, it was like 1981 or 2, that we sold more upholstery than we did wood furniture. And that was kind of a wake-up call, I thought, and I looked into it a little bit. And now looking back, golly, that was so visual that it should have come. And the domestic upholstery continued to do well and continues to do well today. And the mattress industry historically has done very well because both of them had a large component of domestic product. And I think that's really important. That's helped them greatly. And we've been responsive to the importers in those categories where we couldn't be in wood furniture. We couldn't be in metal furniture. The government regulations just prohibited us from building any new facilities. So those categories, I think, will continue to be strong. And it's surprising to me how many of our friends that have their major manufacturing operations in Asia are talking to us about finding them something here in the U.S. And there have been a number of put facilities in Mexico. I mean, a large number, bigger than just the 2 you mentioned off the top of your head. And most of them are thinking that may not have been their best decision ever. That the logistics and even the labor cost and the labor, the working conditions between the labor and their Chinese or Vietnamese or Cambodian employers aren't as slick as they had hoped they'd be. So I still think we're going to see more people looking to buy here in the U.S. We're going to see more people from Asia looking to buy here. And we're going to continue to see people come over here from Europe who want to be part of this market.
So when you say buy, you mean look to acquire companies here in the U.S.
Have a real presence here and not just sit on the outside and try to get a retail container in here and there.
On the retail side, there have been a number of retailers who have expanded rapidly. There are some who have openly expressed an intent to try to develop a national footprint. Some have grown. Most so far, the growth has been organic, right? Rapid store openings across the country. We haven't seen yet a major acquisition on the retail side of somebody saying, I need to get these 3 states, 4 states, 5 states. I'm going to acquire a regional, or I'm going to go acquire my way into a region. Do you see any, as you look down the road, maybe it's 24, 25, 26, do you see any more activity on the retail side where somebody's going to try to accomplish that national footprint and doing it by picking up a big chunk of stores? Or is that just out of the realm of likely?
No, that's going to happen. And it's going to happen for a sad thing. Age. A lot of our best retailers were started by gentlemen we all know, or gentlemen and ladies. And they did it after World War II in Korea. And those people now are in their 70s and 80s and are facing issues on what's going to happen with their business. And like Simon Kaplan, that great gentleman out of New Jersey, told me one time, he says, I know at my age I got to sell my business, but I never paid any of my employees enough money that they can afford to buy it. So, that's a tough thing to admit. But if you aren't blessed with children on board who are excited about the business and want to make the business grow, then that's an issue that has to be addressed by the family. And it's best done while the guy that got you there is still there to tell the story and show what the opportunities are going forward. Yeah, that's one place I can name you probably 12 names that this is in their scope. This is something they know they have to do, and everybody dreads it because we don't want to talk about the day that Pop's no longer with us.
On the acquiring side, what do you think the characteristics are of the companies that are in a position to go make that big buy? And I'm not talking about 2 stores here or 3 stores there, right? We're talking about a fairly substantial operation. What are the characteristics of that kind of operation? Because so far it looks like most of the big players are looking to grow organically. So I'm curious from your perspective whether they have the culture to go and go from being an organic building strategy to an acquisition building strategy.
Sometimes it's not as obvious as that. If a major decides they want to lop off another 25% of the country, they're probably going to go sit down with their top 5 vendors and say, here's what I want to do. But I don't want to take this leap, which is going to be expensive, and it's going to take a long time, unless I know I've got my vendors with me. And as often as not, the vendors will contribute to the affordability of the transaction. And that can be as simple as giving you extended terms on all your purchases made in the first 2 years. Or it can be actual equity investments, or it can be that the new stores that are being bought are owned 15% by some of their vendors. All these combinations are being looked at, and what's occurring is the vendors, the manufacturers and importers are looking at those as a way of controlling and having more comfort that they're going to keep these guys as customers. We've seen throughout the last 2 years in particular, where a lot of manufacturers have woken up, and it's bad enough not getting any orders, but to see all of a sudden where, hey, we've loved you, you've been good to work with, but starting the 1st of next month, we're now dropping you and putting in X. The dealers see what's going on, and they want to make sure that what's on their floor is sustainable and that the people are running a business that is well financed and well managed. And again, I think all this contributed to everything from the United Lane situation and the Klausler situation. Again, all these companies had a story behind them that I hope someday someone's going to write a book about what really, really happened.
I hope you do.
Oh, no. A lot of people got to die before I can write about
them. So, Jerry, we're coming to the end of our time, but I'd like to kind of put a bow on our conversation. If I'm a company and I'm thinking about selling sometime in the next 2 months, 12 months, 18 months? What should I be thinking about?
Well, I'm glad you mentioned the timing, because the timing is so very important. And we have told, I say we, our Jim, Mike now, we've told so many companies that are good companies, profitable companies, well-run companies, not to sell because the timing wasn't right. Now, did we lose business? I can't name one that's gone out, been sold by anybody else either. But you got to look at the timing and when the environment is right. And the environment has to do with financing. It has to do with the consumer outlook. It has to do, of course, with interest rates. But it's really the environment. And every furniture retailer, furniture manufacturer, furniture importer, each has a story. And if you know enough about the people that they compete with or that are in their neighborhood or that need that particular assortment, there are a lot of puzzles that fit right together and will work. There are very few days that go by that, we don't look at these puzzles sometime and say, so-and-so could really use so-and-so over here. And you're right. So, sometimes we just say, look, have you thought about this? Can we help you with this? But if somebody comes to us and wants to sell their business and the timing is wrong and we cannot get them a fair value, we'll say, let's look at it in 12 months or 18 months. And I can't think of one of those that we're sorry we told that. Some of the valuations that have occurred are not what most owners would feel were fair. And the peak valuation on a retailer was done with Bob's, and it was 8.1 times EBITDA back when it was done, and it was done in 96, was it? Something like that. But that was the peak. And then
let's look at the flip side. If I'm thinking about making an acquisition, and I know that there's 1,000 variables, right? I mean, there's opportunistic, who's available, what's the timing, where are they, all of those kinds of things. But if I'm a buyer right now, to what extent does timing weigh in? What kind of things should I be thinking about? What advice would you be giving to people who are in the market for an acquisition to enhance their business and so on?
One, does it really fill the niche you need? Two, you can probably pick it up cheaper right now just because you won't get in a list with 5 other competing elements for that. So that's good. Now, is it going to be a long list of people looking? Yeah, there will be. And there's some companies out right now that are preparing themselves for sale. And they're going to get a lot of bids for their business because they've done a really good job. If you run your business day to day and don't look out for the future and look out for who your competition is and what you need to do, it's going to affect your value. And people, if they're anticipating selling anytime in the next 5 years, they need you sit down with a talented, qualified advisor who can tell them not only what's coming, but what's coming in the financial markets, what's coming with the different types of buyers, strategic buyers. And there are a lot of people out there that look at our industry and say, golly, it doesn't take any smarts to be in that business. And it makes me go crazy because ours is very much a relationship business. And if you don't have the relationships, if you don't have the knowledge of the business, if you don't know who you're competing with, you're going to lose your money. But you got to hire. And I think I wrote a column about this long time. We don't have a lot of advisors out there that are talented and qualified that can be going in and help these people who have made an investment without knowing everything. They need to be more careful about who they hire.
Jerry, thanks for taking the time today. I really appreciate it. As always, your insights are invaluable.
Well, I'm sorry about my collar here. I've got a little white collar there that can go between this one and this one, but it sends the wrong signal.
Jerry, as always, thanks very much.
Thank you. I'm flattered at this, and again, we're here to serve. I welcome phone calls and all our guys that we're like that. We want to hear from you and hear what you need before we can tell you what we can do.
Thank you to everyone for listening to today's webinar. I'm John Anderson, Director of Business Development at GigaCloud, a pioneer of global end-to-end B2B e-commerce solutions for large parcel merchandise. We wanted to let you know about our recently closed acquisition of Noble House and Wondersign, which will provide additional scale and reach for GigaCloud to elevate our reach and enhance our customer stickiness with our marketplace ecosystem. To learn more, visit gigacloudtech.com and gigab2b.com.
Well, that wraps it up for today. I hope you enjoyed this event. I hope you enjoyed these discussions with key industry experts in commercial real estate, in mergers and acquisitions, and our own staff who are in contact with people all across the breadth of the industry. I welcome your feedback on this program, but also would love to hear from you on other topics that you'd like to see us discuss in the coming months. We know that business is challenging, and our goal is to provide you with the tips, tools, strategies, analysis, research, and insights that'll help you be more successful. So on behalf of Furniture Today, on behalf of our sponsors, GigaCloud and 25 Home, I'd like to say thank you very much for tuning in.